For Dukascopy TV, I'm Sophia Aribo with this edition of The Week Ahead. Joining me for a focus on who could be the winners and losers of Europe when data is released over the next 7 days is Raiffeisen Bank's Eva Bauer. Eva, today's data on Greece shows GDP is still falling. Government debt to GDP ratio continues to grow. Is the Greek economy actually doing any better? And are austerity and cuts in government spending the right thing to do when GDP is shrinking?
GDP in the first quarter of this year declined by 1.1% compared to the same quarter of last year. On the one hand, that means that the Greek economy is still contracting. It has been mired in recession uninterruptedly since the end of 2008. Thereby, it has lost more than a fifth of its output. On the other hand, however, there are finally some rays of hope to find in the data. The annual decline of 1.1% in the first 3 months of the year compares to a drop of 6% 1 year ago. Furthermore, the Purchasing Manager Index for the manufacturing industry was at 51 points. This is slightly above the critical 50 points mark, which separates negative from positive growth rates, and it is a level that the index has not reached even once between 2009 and 2013. That means while we're still in negative territory for real growth rates, there are still some positive signs as well. Nevertheless, one has to say the process of recovery is likely to be a long one, with the unemployment rate still hovering around 26.5%. Regarding austerity policies, it's indeed a substantial challenge to cut government spending sharply and thus reinforcing an ongoing recession even more. While spending cuts are very painful in the short term, this process, however, was absolutely necessary in Greece to allow a more productive and sustainable allocation of resources in the future.
GDP figures for the whole of the eurozone are out on Wednesday, and deflation worries could become more concrete. The ECB will also make its rate decision on Thursday. ECB head Mario Draghi indicated he'll act in June using unconventional methods if he needs to. Do you think that Wednesday's GDP release will increase the pressure to act, and what are Draghi's options?
Mario Draghi and the ECB Governing Council certainly are under pressure to act on Thursday. This is underscored by the communication policy that the members of the Governing Council have followed since the last meeting in May. In GDP and inflation data out this week will do nothing to decrease the pressure, more like the opposite. So the prospects for further measures have already been outlined very clearly. A cut in the key rates seems almost certain. Our expectation is that the deposit rate will be cut by as much as the refinancing rate and will thus move into negative territory, whereby our call is for a cut of 15 basis points. Furthermore, we can expect measures that will keep liquidity within the banking system high and promote also lending. One liquidity fueling measure could be the termination of the sterilization of bond purchases conducted under the Securities Market Program. And in addition, we expect to hear an announcement of at least one new long-term refinancing operation in which only certain types of loans, for example corporate loans, can be handed in for refinancing purposes. The so-called funding for lending program would then be the most direct way to influence loan activity within the euro area. Although the possibility that the ECB will announce a wide-ranging QE program, including direct purchases of certain interest rate products, we do not anticipate an announcement regarding such broad and large-scale purchases of securities across various credit segments. However, the ECB is likely to pick its words exactly so as to keep fantasies over such steps alive for some time to come.
Eva, Thursday sees a UK report on quantitative easing and the interest rate decision. Bank of England officials say unwinding QE is unlikely to begin until the key interest rate has risen from its record 0.5%, because they want the option of cutting borrowing costs again if the recovery falters. The US has already begun tapering QE. Why is the situation different between the US and the UK, and when do you see the UK interest rates rising and QE tapering?
While in the US, additional asset purchases will be fully stopped only sometime later in the year. The Bank of England is already one step further, with a hike in the key rate being the next logical step already. While the ECB is easing further and the Federal Reserve is trying to avert rate hikes until sometime in 2015, also the Bank of England is not prepared to start tightening yet. Subsequently, the rate of unemployment as important threshold for the start in the rate hike cycle has been watered down constantly in both the US and the UK. And central bankers in both countries now cling to various other indicators to justify maintenance of record low rates for some time to come. As a consequence of this, we do expect discussions about rate hikes not to intensify materially before autumn, and we expect the probability of de facto moves increasing only significantly towards the end of the year. Actual rates hike we then expect to see only in the first quarter of 2015, with the Bank of England potentially moving a little bit earlier than the Federal Reserve. And finally, the unwinding of the quantitative easing, meaning the outright sale of previously bought securities, will then, in our opinion, be discussed only much later.
Thank you, Eva. For more in-depth analysis of what's making the financial news this week, be sure to check in with Dukascopy TV. Goodbye for now.